Hey, my name's Rajesh. I'm a direct lender based in Los Angeles, and today is episode one of Finance for Creatives. And why creatives? Because normally creatives are self employed and they feel like they're locked out of the housing market. They feel like they have to rent for the rest of their lives, and that is a huge uh, untruth. That's not true. I was an animator. I'm still an animator. I'm using animation tools. I still work on my own cartoons now, but now it's more of a hobby for me rather than my full time job. Um, and I do that because if you want to hate anything, you turn it into a job. All the creatives out there will understand that. If you want to kill your passion for it, turn it into your job. So this is finance for creatives. And lesson number one, the point of today's video is you need to own your own assets. And here is why. One, you're older today than you were yesterday. What does that mean? Every single day, you're going to just keep getting older. You're going to get older. And at some point, you're going to be unable to work. When you're unable to work, you're not going to have a source of income. And that's a problem, especially as costs keep going up. So you have costs here, and while you're working, your income may go like this or may even go like this. But if you're self employed, it's probably like that. And then you get old and your costs become your income becomes fixed, but your costs keep going up like that. And so life just gets more expensive as you get older. So for that reason, you know, that's one reason you need to own assets, because you will get old and you will be unable to work at some point. You will be unable to generate the income you need to live. Whether you like it or hate it, that's the system that we're in, and you need to adapt to that system. Because as with evolution, you either adapt or die. That's what it is. It's cheaper to rent. So, yeah, for this belief, I would say, okay, it's cheaper to use AI. It's cheaper to use Fiverr. It's cheaper to send jobs overseas. Cheaper doesn't always mean better. So if a potential client came to you and said, and asked you for a bid for a job, whether you're an animator, an illustrator, a website designer, a musician, an actor, and they said, hey, I can do this cheaper this way, or can you do this cheaper? I've gotten a cheaper quote here. How would you respond? I know how I respond, which is you get what you pay for. If you want to go cheap, you're going to look cheap. So that's my counter to this. It's cheaper to rent. The next point is inflation is good. Now, all these points tie together. So I know it sounds like I'm rambling and I'm just going through this really quickly, but I'm going to tie it back all together at the end. I promise you. Just stick with me. Give me a few minutes. But from it's cheaper to rent to inflation is good. So whether you believe that inflation is good or not, inflation is benefiting a lot of people. So let's say this is the entire population of the US, the United States, because this video is meant for American economics, not necessarily global economics, although more and more global economics is looking like American economics, in my opinion. So let's say this is the entire US population. And here you have the billionaires. And then you have the political class. And then you have, the middle class. And then you have sort of everyone else, right? Well, actually, it's closer to this. If I were to use actual statistics for effect, it looks nice and when it looks like everybody's poor. But the reality is, these are the billionaires, these are the political class, this is the middle class, and these are people who are just struggling to make ends meet. So let's call them working class. Okay, so like it or not, Keynesian economics, the Federal Reserve, politicians, economics teachers, which they don't really have much of anymore in high school or even junior high or middle school. That's showing how old I am. They just don't have them anymore. What they have are social studies teachers, history teachers, some math teachers, science teachers. They're cutting everything, right? So they're not really having great teachers. Just like not all mechanics are good, just like not all doctors are good, just like not all lawyers are good, or not all teachers are good. We have to be honest about that. Some are really great teachers. The vast majority of teachers are probably great teachers on top of being great human beings, but not all of them are good at what they do, because that's just the law of averages. That's just how averages work. So what my point is that what you're failing to learn in school is the fact that inflation is a fact, is what inflation is. So inflation says, let's say I have $1, let's say I have $100 today, and today I can buy $100 worth of songs. So let's say it costs $1. Let's see here. How can I break this down really easy? So let's say streaming services today cost $20 each. So for $100, I can buy 5 streaming services, or 5 services. Okay? With inflation, this is losing buying power. So this price tomorrow may be $25 each. And when I say tomorrow, I actually mean a year from now, or 2 years from now, or 5 years from now. Call it corporate greed. Inflation is what it is. Basically, you can buy more or buy less for more money. So you got 5 services, so tomorrow it will be 4 services, and then it will be 3 services. Starts out at 20, then 25, then 33, etc. services. This $50 each, and now this is 1 service. So now you're getting 1 service for $100, whereas today tomorrow. And by compressing it on that time scale, you can see what's actually happening. This $100 is worth less and less over time, because today it gets you 5 services, and tomorrow it will get you 4, and the day after 3, and the day after that 2, and the day after that 1 service. So that's inflation. And some people believe that it stimulates economic growth as long as it's not hyperinflation, right? So here's hyperinflation, and here's regular inflation. So this is 2% inflation, and this is 50% inflation. Okay? So the bigger this number, the faster the inflation. Whether you believe that is good or bad, it exists. Just like whether you believe in atoms or not, they exist. Your personal beliefs have nothing to do with whether you believe in gravity. Gravity exists. So inflation exists. And because these group of peoples and this group of people all believe that inflation is good as long as it's below a certain number, inflation will continue to exist. There were times, and there are times in our history, not too distant, where we've seen, not only in the US, but in other countries, where there have been periods of deflation, where this same service may cost, you can get 5 services for $100, but tomorrow, in a deflationary environment, deflation says that this same service, for this same $100, it's worth more and more. So what that means is today you can get 5 services for 100, but tomorrow you might be able to get 6 services for the same $100, or 10 services for $100. That is deflation. So obviously, from a consumer standpoint, this is better. But it's not a question of whether it is, but this is better. But better for who? This is better for consumers. Is it better for producers? Is it better for the people who own assets? Obviously not. So let's say I own this house, right? And it costs me $100 to buy. In an inflationary environment, this house, this very same house, nothing has changed, is now $1,000. That's a 10x difference. Now, this timeline can be 1 day, 1 year, or 10 years, or 50 years, right? The issue is still the same. This price went up without this house changing at all. But on a deflationary scale, as happened with Japan, that same house went down in price or stayed the same. So we have this $100 house, and this becomes now a $50 house. And this may take 1 day, 1 year, or 50 years. This is deflation. And this is inflation. So one, we have services here that are going, in an inflationary environment, we have services that are going up in price, and we have products that are going up in price. A house is a product. Whether you like it or not, you might believe it's a right, just like healthcare, you might believe that's a right. This is not about beliefs. It is about what the current situation is, what the current economic realities are. And the current economic realities are that houses are products, and healthcare is a service, rent is a service, housing is a service, and in an inflationary environment, these costs go up. So going back to this, you're older today than you were yesterday. So in an inflationary environment, here are your costs, and here is your earning capacity. Let me draw that again so that we can line these up. Earning, income, expenses. Your costs are going up, and the distance between this is getting bigger and bigger and bigger. Let me continue this out for you. Right? So here you are, young, old. Day 1, day 1 million, or I don't know how many days people live. Let's see here. Let's do some quick math. So let's say 75 years old. Let's say 70 years old, okay? Times 365. So day 25,000. 25,550. This is retirement, okay? And retirement basically says you stop working, but when you stop working, your income takes a dive, because as long as you're working, you have income. You stop working, your income goes away. And this is assuming that your income keeps up with inflation. It doesn't. It just doesn't. So that means the real picture of inflation or expenses, expense is anything you spend money on, and income is anything that puts money in your bank account. So this is an expense is that something that takes money out of your bank account. Income is something that puts money in your bank account. We need definitions. So here is the reality of income for most W-2 employees. But as a creative self-employed, because you're selling services, you're selling product, in a way you're kind of an entrepreneur. And in the government's eyes, from a tax perspective, you are an entrepreneur, you are self-employed, you are a business owner. And so it's important to understand this because that's how they see you. They don't see you as an artist. The art that you create, the music that you create, the movies that you make, the houses that you make, those are just products and services that you are selling. What you are is a business owner in their eyes. And your income generally keeps up with inflation because as inflation goes up, you can increase your rates. So your path probably looks like this. But at some point, because you're human, you're going to get old. You're older today than you were yesterday, and tomorrow you will be older than you are today. You're not only going to get old, you are getting old. That's just what it is. So as long as your income does not keep up with your expenses, you are suffering the effects of inflation. So inflation might be good for the economy, but for you it is not good. And now let's see that it's cheaper to rent. So here we are with a sample or a mock-up. I know artists, you don't like to look at spreadsheets. I'll make this as simple as possible. You're going to buy a home for $1 million. You're going to put 10% down. Even if you put 3.5% down or 5% down, that's not the point. The point is, I want you to look at the total monthly payments on the loan. If you get $1 million home and you put 5% down, you are paying just principal and interest. It's going to stay fixed for the rest of your life and or for the duration of the loan. And on a 30-year loan, you're looking at about $6,200, $6,300 a month. Okay, right there. So that is your monthly payment. Now let's say that same $1 million home, if you were to get it, costs $3,500 a month, right? That's awesome. Let's say you are 25 years old. You're paying $3,500 a month. You're renting a single family house or a studio or a loft in downtown LA or whatever. Year 2, your rent goes up from $3,500 to $3,600. From year 2 to year 5, now that same place is $4,000 a month. Year 10, it's $5,000 a month. 20th year, it's $7,500 a month. Year 30, it is $11,000 a month. So let's say, and over the course of your living there, you will have spent $2.4 million over 30 years. So you're 25, you turn in 30 years, you're 55, and you're not going to die at 55. You're not going to stop paying rent at 55. You're going to have to continue paying rent for the rest of your life. And within 10 years, this jumped up $4,000 because of how inflation and interest compounds. So you went from $3,500 to $3,600, but then you jumped up by year 30 at age 55 to $11,000 a month. Whereas on the monthly payments, they stay fixed for life. So over the 30 years, that $1 million home has cost you, just principal and interest, $2.1 million. Let's round it up to 2.2. Rent has been $2.4 million right there. Okay? And this is a calculator I made for investors, people who buy apartments and rent them out, buy homes and rent them out. And you're saying, well, Rajesh, you don't, the only cost isn't just the principal and interest of mortgage payments. You've got to pay property taxes, you've got to pay insurance, you've got to pay repairs, maintenance, all these other bills that you don't really have to worry about when you're paying just rent. Well, in today's environment, you have to pay your own utility bills. So whether I put zero here or $100 here a month for each of those items, you're having to pay that whether you rent that or not. Property taxes and insurance, yes, that is wrapped up in the rent. But let's find out what it looks like um, over, you know, over the course of 30 years. So we are looking at roughly $1 million here, $1.1 million. And maintenance costs, I put it at 10% of the mortgage payment. So let's see here, B52, which is what? What is B52? So your income from the rent, if you were to rent a place out, it would cost, from a landlord's perspective, about 5 to 10% of the rent goes towards maintenance costs. And I'm not saying that every month you're going to have these small repairs costing $350 a month. I'm saying that sometimes they might hit all at once, and it might be 10 months before you have a problem, and now you're having to deal with a $3,500 problem. You may have to deal with a $25,000 problem. But those are generally one-time expenses that you need to be saving for. And so over here, I'm putting that as being, over the lifetime of owning this house, you're having to spend about $200,000 on that. So if I were to add all these costs up, here is what you get. You have about, let me actually update this text here. This should be expenses, net operating expenses. You are spending about $1.3 million. If I were to add all this up, it would be roughly 1.3 million. We have these two numbers, property taxes and insurance, and then maintenance. So that's 1.3 million dollars, and you can see that right there. If I go up to 200%, there we go, 1.297 million and 450. So for me, that is looking like 1.3 million plus the 2.1 right here, right? So that's 3.5 million. So yes, it is cheaper, but there is a terminal endpoint to this. So once, after 30 years, your house is done being paid off. You're done paying it. This is 30 years cost right there. And remember, you're started at 25, you're ending at 55. From years 56, 57, 58, 59, blah, 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 until you die, probably another 30 years from, if you're a creative who is doing as well as you are doing, you are going to be you're going to live a long time, because in America, in a capitalist system, the more money you have, the longer you live. So let's say you live another 20 years, right? So these principal and interest costs, they go away. They stop at year 30, but the rent keeps going. The rent keeps going, and that's $11,000 a month starting year 30. And this cost right here, the net operating costs, right? Those also keep going. The maintenance costs, they keep going. So let's see what this looks like by the time this property is in year 30. And what I'm going to do is essentially move the figures from year 30 to starting costs. So the property values in 30 years are going to be $5.7 million, because that's generally the rate of appreciation in California on the super conservative side. You're actually looking at about 8 to 10% appreciation historically in Los Angeles. But across the U.S., you're looking at between 5 to 6%, 5 on the low side, 6 on the high side. And if you're in Los Angeles, 6 is below average. So I'm being super conservative here. Okay, rental inflation in the U.S. is generally about 3.18%, 3.2%, somewhere in that range. Los Angeles inflation rates are actually higher. When I'm talking specifically about rental inflation. And then you have yearly inflation. This is generally US-wide. The CPI index over the past 100 years has averaged about 3.29%. So nothing I'm doing here is made up. So let's see, 5743491.17. So let's say that's the starting value of your house. And now you've got a home that you fully own, right? So there's zero interest, zero mortgage payments on it. And yearly inflation stays the same. So we said that this was the starting interest rate, starting rent on day one. So let's say you live another 20 years, right? Well, let's say another 30 years. So from 55 to 85. Now your rent costs you about 7 million. You'll have spent 7 million. So by year 20, by the time you're 75, your rent is going to be $24,000 a month for that same apartment that you're currently living in that originally cost you $3,500 a month. Whether that's a single family home, an apartment, a condo, a loft, that it's going to be about $24,000 a month 50 years from now. 30 years from now, that same place is going to be $36,000 a month, and you'll have spent $7 million. But on a home, your cost will be that fixed $2.1 million that you had originally spent. And let's see the net operating expenses here. So property taxes will cost you about $5 million, another $100,000 there. So you'll have spent $6 million here. So $6.4 million versus $7 million here, plus the original $2.4. So let's do some quick math, right? Your favorite subject, I'm sure. So let's see, renting 1 through 30 is equal to 2.4 million. Owning or renting 31 through 60 is equal to 7.7 million. And then owning, we had, I believe, 1 through 30, it was 3.1 million. And then 30 through 60 is equal to 6.4. Okay, so let's see here. Let's do some simple math. 2.4 plus 7.7 is equal to 10.1 million in total costs, right? And then we have this. So that is 5, 9. So 9.5 million owning. All right, so this is the cost in ownership difference, $600,000. Over a long enough time horizon, owning becomes cheaper. And every time you move, if you're upgrading your apartment or even just moving sidewards to the same apartment, your costs are going to stay in this same pattern. You're not going to move to a cheaper apartment. You're going to move to an apartment that is the same or more expensive as your earning powers go up, and then you get old and you've saved nothing for retirement. Whereas with ownership, your home is your asset. So now let's see what this home looks like by the time you are 85. Because again, you're a high earner, and as a high earner, you're going to have a longer lifespan, generally speaking. So let's see what this home is worth in, let me update this figure right here as well. We need to choose this property value. So in 60 years, right, when you're 85, the equity in your home is going to be about $25 million. So here is, the home's going to be worth $31 million, but after all your expenses on the mortgage payments and everything, you're going to be left with about $25 million, which is 25 million minus the 9.5. Let's just round this up to 10. That will give us 15.5 million. Well, 15 million, but if we keep this at 9.5, we're left with 15.5 million. So now you have 15.5 million in equity that you can pass to your kids. You can leave to charity. You can leave to some sort of historical organization. You can use for equity for when you have emergencies as a credit card and pull out maybe $100,000 when you need it. And then, yeah, that's a loan, and you're probably going to repay $200,000 over an additional 30 years. But 200,000 versus 15 million, 200,000 divided by 15.5 million, right, times 100. So you're looking at 1.29% of the home's value. So that's the difference between renting and owning. And that's why this cheaper to rent, yeah, you get what you pay for. Because over here you have to rent for the rest of your life with no equity. Whereas over here with ownership, whether it's a house or stocks or whatever, you own something. And you might say, okay, well, I'll just rent and put money in stocks. But remember, this is, as a housing expense, this is your total expense, but you get this in return, right? Whereas this is your expense, 10 million, plus you got to put additional money into the stock market to get this. So to get, if you rent, it will cost 10 million plus stocks. Owning is just, even if we equalize it, it's 10 million. That's it. So your expenses are still less with home ownership. So that is why I don't buy the it's cheaper to rent argument. You get what you pay for, and you tell your own clients this all the time for good reason. And the reason I'm doing this is because no one is coming to rescue you, even if they wanted to. So imagine two people, right? This guy here is someone who fell and cannot get up. Here is a person with no arms, and here is a person with arms. The likelihood, I'm not saying it's impossible, but the likelihood of this person helping this person is close to zero. The likelihood of this person helping this person is greater than zero. It might be 1%, it might be 99%. This is zero, but this is greater than zero. That's it. So if you have the ability right now to help yourself, Let me rephrase this. Most people in the US right now do not have arms. They are barely able, they're struggling to get by, right? They aren't able to help themselves. The chances are that they will be able to help you are close to zero. The people with arms that are able to help you is yourself. You're the person with arms. You can help yourself before anybody else gains the ability to help you. So that's just where we're at. That's just reality. If you need to change what somebody else does in order to better your life, your chances of success are zero. But if you can change your own actions in order to get the success that you want, whether that is achieving a goal, hitting a certain financial number, whatever it is, achieving your dream, traveling to a location that you want to do, checking off every item on your bucket list. Success to me is just achieving a goal. Whatever that goal is, whether it's a financial goal or a personal goal or an emotional goal or a relationship goal, whatever that goal is, you can do that without controlling somebody else's actions and controlling your own. You have a better chance of achieving it. So that is why I am doing this video, because no one is coming to rescue you. You need to look out for yourself. And then when you are able to look out for yourself and help yourself, then you are in a better place to help others. The person who is struggling to get by is not going to be able to help others. The person who is not struggling to get by is going to be able to help others. So even if you believe in helping others before helping yourselves, in order to help others, you need to help yourself first. And this is the reason why. Because if this is your path is 10 million plus extra. Whereas if you own, your path is 10 million flat. And this is, again, assuming $1 million home and that your rent is $3,500 a month. That's your starting point. So if you are a creative and you cannot qualify to buy a home despite earning, $100,000+ a year, you're earning $150,000 a year, you have great credit, but you cannot qualify for a home loan, it's because banks were not made for you. The economy was not made for you. It was made for people who have a single job, who get a W-2 from their employer, who have their taxes already withdrawn, but you have not only the income that you have, but all the expenses. And you are taxed on whatever is left over after your expenses. Now, you may write off certain things that maybe you shouldn't write off. Or maybe you write off honestly, but you're still able to afford things. Well, as a lender, I work with people like you whose tax returns do not tell the whole story. And this is why I do it. Because you cannot help others unless you help yourself first. So if you are looking for a lender who is able to help you, hit me up in the comments or go to my website. The link is in the description.